Let's take the Trinity Alps motorboat rental problem one step further, and this is an important point related to Chapter 12 material on externalities and optimum policy response. Remember, we have this market where the demand is given by P equals 300 minus 2 QD, 2 times the quantity demanded. Supply is given by 60 plus QS. And remember that there's this marginal external cost that's constant at 30. And what I want to think through is the optimal pollution tax, often called a Pigouvian tax. If we knew that the damage function was such that at the social optimum, the marginal external cost was exactly $30 per boat rental, well then taxing sellers or buyers, doesn't matter, putting a $30 per daily boat rental tax on this market will internalize what had been an externality. And what's more, in moving the market to its efficient outcome, this tax will generate government revenue, and that revenue can be used to offset reductions in income taxes, payroll taxes, taxes on investment effort, the taxes on the good things that were unfortunately required to tax in order to gain revenues to support necessary government services. But if we could put those taxes on bad things and discourage bad things instead of good things, well, that's a win-win for the economy, for the environment, for the provision of government services. So let's think through the analytics of this case and realize that you can give yourself an infinite number of problems. Just make up a different demand curve, make up a different supply curve, think of a different externality. You got a new problem. Just practice, practice, practice. Well, I've transcribed some of the information from that problem here, but I wanted to just talk you through what would happen if we taxed this market to the tune of $30 per boat rental. And it doesn't matter a whit whether we tax buyers or sellers. The way we analyze taxes is to realize that buyers are now going to pay, let's let P be what buyers pay. P is what buyers pay. But sellers now receive P minus the tax, which in this case is P less 30. So all a tax does, and this is true whether you put a tax on buyers or sellers, whether you tax buyers or sellers, the economic effect is the same if that tax is tied to the quantity of goods sold. Anyway, buyers receive P minus this $30 tax. So that demand function stays the same in terms of P. P equals 300 minus 2QD. Buyers are making their decisions related to whatever price P they're seeing, but sellers aren't seeing price P. They're now seeing price P minus 30, and it's that price that's leading them to make their output decisions. And so when we move the 30, we add 30 to both sides, we get P equals 90 plus QS. That captures sellers' behavior in this market. And again, it doesn't matter whether we're taxing buyers or sellers. Our equilibrium condition is still going to be that the quantity demanded equals the quantity supplied. So these Qs, QS, and QD are going to be the same. But watch what happens when we solve this market in the presence of a tax. So 300 minus 2Q is equal to 90 plus Q. And that means 3Q is equal to 210. That means Q is equal to 70. Well, I didn't ask, but let's just take this home. Price is equal to 300 minus 2 times 70, 300 minus 140, it's $160 a day. for renting a boat, and then sellers only get $130 a day. The government takes $30 for each boat rental. And then the tax revenue is equal to the quantity sold, 70, times the amount of tax collected per boat, that's 30, and that is equal to $2,100 per day. And then we can see that, remember our work from the previous application exercises, we can see that this tax moved the market to the socially optimum level of output. Let me show you the graphical analysis of that case. This is a really important set of skills to develop. Remember, we had this supply-demand framework, rentals per day, price is $1 per day rental. That dollar sign didn't really work out very well. I guess it's bad enough that I should correct it. Not pretty, but at least it looks like a dollar sign. Remember, we had a y-intercept at 300, x-intercept at 150, and we had a supply curve. This is demand curve, and this was market cleared at 80. Looks a little bit better than it did before. And the way we analyze the tax, I'm going to change color so you can see the tax. I'll do the tax in orange. To solve for the tax, what we're doing is just looking for the quantity where the vertical distance between the demand curve and the supply curve is exactly $30. If it's a $30 per boat rental tax, there will only be one point like that. And we know from our algebra that that occurs at 70 boats rented per day. The price that buyers pay was $160 per boat rental. Remember, this was 300. And the price that sellers received was $130. And then the area of this rectangle is tax revenue. It's $30 high by 70 boat rentals wide, and we multiply that through to get $2,100. So that graphical case, and notice something else about this graphical analysis. I'm not adding a new supply curve. I'm not shifting the demand curve. This analysis, where we just analyze this tax as a wedge between what buyers pay and sellers receive, that's the easiest and most economically correct way to analyze a tax. And it emphasizes the point that it doesn't matter. The economic effect doesn't change depending on which party you tax. I guess we can go even one further. Let me go back to black. You could see it by the way I've drawn it, but before the tax, the market clearing price was $140. Notice that buyers have paid $20 of the tax. The price buyers pay goes up by 20. Sellers have paid $10 of the tax. The price that they receive has gone down by 10. So 2/3 and 1/3. Buyers pay 2/3 of the tax. Sellers pay 1/3 of the tax. We call that the economic incidence of the tax. And notice that it doesn't make any difference whether we collect the money from the buyers or the sellers. The economic incidence is the same. The legal incidence, if we collect it from buyers, the legal incidence is on buyers. If we collect it from sellers, the legal incidence is on sellers. But whichever the legal incidence is, however the legal incidence goes, we could split it in half like they do payroll taxes. But the economic effect, who pays what share of the tax, is independent of the legal incidence of the tax.